Good morning, everyone. We have a full agenda today as we discuss the current state of the macroeconomy and our responsibility to fulfill our dual mandate goals, maximum employment and stable prices for the benefit of the American people. At our last meeting, we cut rates by 25 basis points, given an increase in unemployment. Labor demand had softened, with pace of job creation running below the break-even rate to hold the unemployment rate constant. Inflation has eased significantly from its 2022 highs, but remains somewhat elevated relative to our 2% long-run goal. We find ourselves in a challenging situation, with risk of inflation on the upside and unemployment towards the downside. We'll start this meeting by looking at the growth outlook and move on to labor market conditions, followed by a discussion of the inflationary environment and other important factors to note before concluding with a vote on our forward guidance.
Demand for employment has been low over the past few quarters, and we forecast the unemployment rate to reach 4.5% by the end of 2025. Shortly after, we expect the unemployment rate to decline due to our September rate cut. It's important to note that an increase in overall spending, as well as an increase in net exports, has contributed to the growth of GDP. Even as we have lowered rates in September to contradict current labor market conditions, inflation will continue to rise, exacerbating the importance of our dual mandate.
The question is whether the pace of inflation is sustainable. In the second quarter, GDP grew approximately 2% from a year ago, but the signs show that the economy is contracting. Despite facing the risk trade-offs of increasing unemployment and increasing inflation, we believe that the economy is in a healthy state. While demand is softening primarily due to growing uncertainty over current fiscal policy, it is important to remember that growth is not a component of our dual mandate. Instead, our focus remains on maintaining labor market stability and managing inflationary pressures.
Let's look at how the labor market has been performing. The unemployment rate remains relatively low at 4.3% as of August, a slight uptick from the 4.2% gathered in July. Among those who are unemployed, individuals aged 20 to 24 seem to be the most at risk, at a rate of 9.2%. They are significantly more unemployed than older age groups. The labor force participation rate is at 62.3% as of August. From June to August, the rate saw limited movement, with not many people entering or leaving the labor force. As we know, monetary policy operates with a lag, so we must be proactive. A rate cut could promote more job openings and help prevent unemployment from drifting higher in the coming months.
That may be true, but I disagree. We should also consider whether a rate cut would help the 20 to 24-year-olds find a job. I believe advancements in AI are contributing to the lack of entry-level jobs for college students.
AI may play a role, but it is unlikely to be the root cause of the current economic situation. Let's examine the agricultural market. As of August, the unemployment rate stands at 6%, a significant increase from 3.6% in July. This rapid rise is more likely related to immigration policy rather than AI. Additionally, overall job openings have been declining. In August 2024, job openings were 7.6 million and further decreased to 7.2 million this August. This trend indicates a steady decline in job availability, suggesting that the job market is softening. Given this information, I believe a rate cut is necessary.
Wage growth is crucial for our labor market. The 3-month moving average for wage growth was 4.6% in August 2024, but had decreased to 4.1% by August of this year. This indicates a year-over-year decline in wage growth, which is being rapidly outpaced by inflation. In a tight labor market, I expect to see businesses raising wages. For example, in July, the construction sector had 309,000 job openings and will likely increase wages to draw in more candidates. However, individuals aged 20 to 24 have not been filling these positions quickly, as many hold degrees and would find themselves underemployed in this sector.
We should also acknowledge the role of immigration. Immigration provides labor markets with a resource. However, we should not expect this to continue. Recent fiscal policy indicates a decline in immigration over the coming years, ultimately meaning the labor market may not be able to sustain itself. H-1B visas are also important to note. These visas provide businesses with STEM employees where domestic workers may not be able to fill this role. While immigration is out of our scope, it's important to keep in mind when making decisions and to continue following our dual mandate.
One more concern is the public's perspective. In response to the recent interest rate cut, we aim to combat unemployment. But according to the New York Fed Consumer Survey, the average perceived probability of finding a job if someone was to lose their job today has dropped to 44.9%, the lowest level since June of 2013. This kind of sentiment can create a negative feedback loop. If households and businesses fear job losses, they reduce spending and investment, which can in turn lead to those job losses materializing.
We may already be seeing early signs of this. Both consumers and firms are uncertain about current and future conditions, and it's showing up in spending behavior.
If anything, these findings suggest we should approach our next rate decision with caution. While we must be proactive in preventing labor market deterioration, we also need to avoid stimulating demand prematurely, especially when inflation remains above target.
Let's now shift our focus over to inflation. Inflation has gradually trended upwards over the past few months and is at 2.95%. Since our September rate cut, inflation has continued upward as predicted. The producer price index by all commodities has increased since the second quarter and rests at a 2.7% change, an increase from the third quarter of 2024. While many businesses have announced passing on price increases from tariffs to consumers, they have absorbed the cost of tariffs without passing the cost. So, however, that may stop being the case. The effects of tariffs are expected to be short-lived. Looking at the CPI now for all urban consumers, excluding food and energy, there was a 3.11% increase over the year ending in August. We have observed a steady increase in inflation since May. I believe we are approaching a point where another rate cut could increase inflation to over 3%, which is higher than our 2% benchmark.
A further rate cut to reduce unemployment certainly promotes caution as we monitor the uncertainty and effects of fiscal policy on immigration, tariffs, and AI. While an increase in employment is encouraging, I also caution against moving too quickly. If we continue to drop rates further, we risk creating a potential stagflationary environment if wages do not keep up with the rising inflation. We are seeing flat to declining consumer spending because for many households, wages are failing to keep up with rising prices, especially for low-income households.
Currently, quarterly headline PCE has trended downward since quarter one of 2023, but core PCE slowed to 2.5% since its 3.5% peak in quarter one. The core PCE decreased to 28.57% in quarter two, despite its recovery of a 34.61% increase in the prior quarter. While headline PCE has trended downwards, core PCE has slowed significantly from the preceding quarter. This indicates that underlying inflationary pressures are still present and felt by households.
Moreover, proposed changes to immigration policy could exacerbate labor shortages, particularly in industries like agriculture. Reduced labor supply could lead to higher wages for domestic workers in these sectors, driving up food prices. However, food prices account for large amounts and portions of the CPI and PCE. Ultimately, this would lead to forward upward pressure on the overall inflation rate.
While current inflation readings have worsened, looking at the 10-year break-even inflation rate, we observe that inflation expectations have also increased since April, generally fluctuating between 2.2 and 2.4%. However, we have seen increased volatility recently, followed by a relatively stable expectation of 2.4% since July. While expectations are falling short of our target, the slight instability underscores the importance of not moving too aggressively. Premature easing could tighten expectations, complicating our path back to a sustained 2% inflation rate.
Given these factors, our inflation outlook demands caution. We are moving away from our 2% inflation rate, adding pressure to a stagflation environment, and the presence of core inflation stickiness and external risks argues against aggressive easing at this time.
Financial markets remain looser than average. The Chicago Fed's National Conditions Index currently sits at negative 0.56, showing calm markets and readily available credit. This suggests that there is little need for us to cut rates to support financial stability. Current policy is not overly restrictive as markets compensate by providing liquidity. From a stability perspective, there is little need for any action.
I'd like to add that market volatility has also been subdued. The VIX index has been trending downward since quarter one, and equities have rallied strongly, bouncing back from February lows, with the S&P 500 now making new highs. This signals a more risk-taking investor mindset. Given the easing financial conditions, a cautious approach is needed as a cut could fuel asset bubbles. Consequences of a price bubble could add to the deterioration of labor conditions.
While that may be true, not all signs point in the same direction. The 2 year bond yield dropped to 3.52%. Markets are expecting that we will ease policy in the near term, especially in response to softening labor conditions. We risk falling behind the curve by not cutting rates as economic momentum slows and the labor market shows signs of softening.
Not necessarily. The 10-year Treasury currently sits at elevated levels just above 4%, signaling that inflation is still persistent. The current yield remains somewhat distorted, but the inversion has eased compared to 1 year ago. This suggests that recessionary fears have declined, but rates are likely to stay higher for longer. If anything, this amplifies our need to proceed with caution.
Credit spreads add another layer. Investment grade spreads have narrowed to 74 basis points, the lowest since 1998, and high yield spreads sit significantly below the long-term average at 524 basis points. This suggests investor confidence as well as expectations of rate cuts in the future. On the one hand, this gives us flexibility and no stress signals. On the other, easing policy in such loose conditions could amplify risk taking and erode confidence in our commitment to our dual mandate.
Still, we cannot ignore household balance sheets. Total household debt continues to rise, reaching 18.4 trillion in Q2, with 4.4% being in some stage of delinquency. Borrowers 50 or older are leading the rise in student loan delinquencies, while 18 to 29-year-olds are facing higher delinquencies in credit cards, auto loans, and other forms of debt. The personal savings rate is just 4.4%, well below pre-pandemic levels. Households have less of a buffer against shocks. If we are late cutting rates, these pressures could spill into weaker demand and amplify weaker labor market softness. By being proactive, we could provide relief without destabilizing financial markets with a cut.
I agree that household debt is a concern, but the debt service ratio is still below pre-pandemic levels and is not yet raising concerns. This suggests household balance sheets are not under major strain. If we cut rates, we risk further igniting inflationary pressures and encouraging additional borrowing from households. While some household debt stress does exist, particularly among those age groups facing higher unemployment, they are not widespread. So the challenge is finding the right balance and providing support where needed without acting too prematurely.
Import prices rose steeply during 2021 and 22, reflecting global supply chain disruptions and elevated energy costs. These increases fed directly into domestic inflation, especially in goods markets. More recently, however, import prices have flattened or declined in several categories, easing cost pressures and supporting the disinflation we've observed over the past year.
Broader current account, which includes both trade and income inflows, has remained at a deficit since the pandemic. However, in Q2 of 2025, this deficit narrowed sharply. Ultimately, the United States continues to rely heavily on foreign capital inflows to finance domestic demand. External conditions remain relevant regarding our financial stability. One important channel is foreign holdings of source of financing and helped maintain borrowing costs. At the same time, they underscore the interconnectedness of our trade policy in global financial markets. A shift in foreign demand could have implications on interest rates and therefore the transmission of monetary policy.
Thank you, everyone, for the thoughtful discussion. Today's conversation highlighted the difficult balance we face between elevated inflation and softening labor markets. As we move to our vote on forward guidance, let us carefully weigh the risk on both sides of our dual mandate. Our responsibility is not only to today's economy, but also ensuring a stable path forward. The committee proposes to keep the target range at 4% to 4.25%. We will also continue to provide clear, evidence-based communication reflecting our data-dependent and risk management approach. Let's proceed to the vote.
Aye. While a rate cut may help soften labor market conditions, it is prudent to wait given the elevated price level.
Nay, this risks our policy falling behind the curve. I believe a 25 basis point cut is in order to avoid further labor market deterioration.
Aye, holding rates steady helps prevent amplifying inflationary pressures, but we must remain vigilant in monitoring inflation risks as policy normalizes.
Aye. We must avoid setting expectations for future rate cuts when policy remains firmly data dependent. While markets anticipate further easing, current issues on both sides of the dual mandate persist.
Aye, we have reached a consensus. We stand ready to adjust our policy as incoming data dictate, ensuring that we continue to support both maximum employment and stable prices. This meeting is now adjourned.